Mark here from Success with Options. I wanted to bring you another video, and specifically this video is going to show you a little bit about managing a calendar spread. In our Trade of the Week series that I've been doing, I have a number of trades on, including one calendar spread that's currently in place on the SPY. Now this is a put calendar spread, and as you can see, it's actually the SPY is going in the wrong direction for this particular position. I put the trade on at around 104, and you can see we have a $100 put. So we're expecting that the SPY will actually move down to 100 at some point. In fact, what's happened is we've seen that the SPY has moved up towards 107. We're almost there right now. So what I wanted to do is take a look at a couple of different possible ways to manage this position, as well as doing some analysis on what could happen based on the movement and time progression of this particular trade. The nice thing about the Thinkorswim platform is that it offers an analyze capability. It's probably one of the more complex capabilities that is found in the trading platform. But what I wanted to do is take a little time and maybe just demystify what we're looking at here. To begin with, let's take a look at how the Analyze tab looks when we first enter. We have no positions that are being displayed in the risk profile, and we currently have a list of trades that are outlined in terms of our current positions. We may have some simulated positions if we've done that sort of thing. What I want to do is go ahead and take a look at our SPY position. So if I type that in, immediately what we see is a graph or a chart of a calendar spread. If you're familiar with calendar spread profit profiles, this would look pretty familiar to you. What we see on the green line is a risk graph or a profit graph of the position on its expiration, which is October 17th. It's about, well, actually it's about 30 trading days from now. So the other thing to notice is that there is this darker blue area and lighter blue area. The lighter blue area represents the current projected potential movement between now and October 17th. So that's our probability date. And what it's showing us is what one standard deviation from the current price, which is 106 odd dollars, 106.74, I think I saw the quote at. So what we can do is take a look at our position. We see that right now the peak of this trade is at the lower end. So it's still possible within the current range of volatility and the current price that we're at to see this actually hit our price target, which would be right at $100 by October expiration. If that happens, we'll realize our maximum profit. Let's go ahead and just look at a couple of different things that we can do with this analysis page. First thing I might want to do is mark my slices off in terms of my upper and lower break even. So I can go in and set slices to break even on 10/17, which is expiration. And we see that break even right now is going to be somewhere between 106, just under 106 on the top side, and about 94.50, 94.59, I guess it is, on the lower side. So that's basically our range of profit on that trade. Notice also, if you look at that white line, it doesn't seem to show a whole lot of profit right now. It's a lot rounder type graph. What I want to show you is a quick way that we can do some analysis on what the position might do as time progresses. So let's say that, for argument's sake, that time just progresses forward, and I'm going to go down here to this date area, and I'm just going to move the calendar forward, and let's see what happens to the white line in terms of doing a projection here. So I'm just going to increase the days, and notice what happens. For one thing, as less and less time is available between the time that's marked on that date and the expiration date, we see that the range of movement is a lot smaller. Keep in mind that the probability of movement, that one standard deviation, is for a range of time from the current time to the expiration date. So the less time there is, the less possible movement there could be between those starting and ending dates. So that's why you see that range go smaller. But notice that as we keep moving this forward, all the way to the expiration date, we see that our real profit potential is mimicking the projected profit potential. I want to go ahead and just set that back for a second. So That just kind of gives us a rough idea of what we can do. So this is our current profit and loss graph of the position if we don't do anything. But what I want to do is show you what we might consider doing to offset some of the risk. So the question to ask is, well, where might the SPY go up? If it's not going to go down to 100, then where will it go? Well, it could continue to move up to 106, 107, 108, 109. We don't know. So what would happen if we were to go in and add a simulated trade? And let's go ahead. We already have this, the SPY options chart up. So let's see what happens if I create an October. Let's start with a 109 calendar, and let's just go with the 1 month calendar. So what I'm going to do is add a simulated trade. Currently one contract, and it's a November-October, which is different than our current position, which is in October-December. What I'm really interested in doing at this point is protecting the upside risk a little bit. So what I want to do is see what might happen if I was to add a call calendar to the upper side in terms of our overall profit and loss of the position if we add those two together. So let's see what that looks like. Here what we see is that we've moved our upper side loss amount above the previous break even, which was just below 106. As we can see, it was 105.83. Now we've moved our break even point all the way out to just about 109. So if I do my set slices, well, let me just add a slice right here. I'll just move that slice over. So we see that it's about 109. So just again, really quick, we can switch back and forth between the two. Here's our position that we have on, and here's what our position might look like if we add to it. Two things we want to point out. Yes, it does improve our overall risk on the upper side, but what do we have to pay in order to accomplish that? Well, if we look at our calendar spread, here we have a position that is trading at, looks like our profit would be on the upper side somewhere around $400. Now if I was to put this calendar spread on the upper side, I remove some of my risk on the upper side and raise my break-even point, but what do I have to pay in return? It looks like our profit drops to about $300, so we're giving up some profit. In fact, I would project that the profit we're giving up is the cost of putting that trade on the upper side. So it's important to understand that we never get anything for free. If we're going to try and remove some risk on the upper side, then we've removed some profit and added some risk to the lower side. And that's just the reality of putting a trade on. But it allows us to basically do a quick analysis and see what we might be able to do in terms of the trade. And that's the kind of thing we want to do. If we decided that we wanted to put that trade on, then I could simply right mouse click, create duplicate order, and now I'm on the order page, and I could set that trade up, one contract, place it, and if we got filled, then we would actually have a position that simulates this risk profile. I hope you found this video helpful. Successful options trading is not just a matter of knowing how to construct a trade or how to enter or exit the trade. Successful options trading is built around a trading system that includes a trading plan with rules for selecting the stock or ETF, rules for selecting the options, rules for entry and exit, and rules for money management. These elements help produce consistency, and that is the #1 attribute of successful options traders. For more information on options strategies, building an options trading system, options broker reviews, and more, please visit www.successwithoptions.com. Thank you and happy trading.